Every candlestick tells a story of the showdown between the bulls and the bears, buyers and sellers, supply and demand, fear and greed. It is important to keep in mind that most candle patterns need a confirmation based on the context of the preceding candles and preceding candle. Many newbies make the common mistake of spotting a single candle formation without taking the context into consideration. For example, a hammer candle represents a near-term capitulation bottom if it forms after 3 preceding bearish candles, whereas hammer candle that forms on flat, sideways candles is basically useless. Therefore, it pays to understand the story that each candle represents in order to attain a firm grasp on the mechanics of candlestick chart patterns. These patterns tend to repeat themselves constantly, but the market will just as often try to fake out traders in the same vein when the context is overlooked. Candlestick charts tend to represent more emotion due to the coloring of the bodies. It's prudent to make sure they are incorporated with other indicators to achieve best results. Hammer candlestick. The hammer is a bullish reversal candlestick. It is one of the most widely followed candlestick pattern. It is used to determine capitulation bottoms followed by a price bounce that traders use to enter long positions. A hammer candlestick forms at the end of a downtrend and indicates a near-term price bottom. The hammer candle has a lower shadow that makes a new low into the downtrend sequence and then closes back up near or above the open. The lower shadow, also called the tail, must be at least 2 or more times the size of the body. This represents the longs that finally threw in the towel and stopped out as shorts start covering their positions and bargain hunters coming off the fence. A volume increase also helps to solidify the hammer. To confirm the hammer candle, it is important for the next candle to close above the low of the hammer candle and preferably above the body. A typical buy signal would be an entry above the high of the candle after the hammer with a trail stop either beneath the body low or the low of the hammer candle. It is prudent to time the entry with a momentum indicator like a MACD, stochastic or RSI. Shooting star candlestick. The shooting star is a bearish reversal candlestick indicating a peak or top. It is the exact inverse version of the hammer candle. The star should form after at least 3 or more subsequent green candles indicating a rising price and demand. Eventually, the buyers lose patience and chase the price to new highs of the sequence before realizing they overpaid. The upper shadow, also known as a wick, should generally be twice as large as the body. This indicates the last of the frenzied buyers have entered the stock just as profit takers unload their positions, followed by short sellers pushing the price down to close the candle near or below the open. This in essence traps the late buyers who chased the price too high. Fear is at the highest point here as the very next candle should close at or under the shooting star candle, which will set off a panic selling spree as late buyers panic to get out and curb losses. The typical short sell signal forms when the low of the following candlestick price is broken with trail stops at the high of the body or tail of the shooting star candlestick. Doji Candlestick. The doji is a reversal pattern that can be either bullish or bearish depending on the context of the preceding candles. The candle has the same, or close to open and closing price with long shadows. It looks like a cross, but it can also have a very tiny body. A doji is a sign of indecision but also a proverbial line in the sand. Since the doji is typically a reversal candle, the direction of the preceding candles can give an early indication of which way the reversal will go. If the preceding candles are bullish before forming the doji, the next candle close under the body low triggers a short sell signal on the break of the doji candlestick lows with trail stops above the doji highs. If the preceding candles are bearish, then the doji candlestick will likely form a bullish reversal. Long triggers form above the body or candlestick high with a trail stop under the low of the doji. Bullish engulfing candlestick. A bullish engulfing candlestick is a large-bodied green candle that completely engulfs the full range of the preceding red candle. The larger the body, the more extreme the reversal becomes. The body should completely engulf the preceding red candle body. The most effective bullish engulfing candlesticks form at the tail end of a downtrend to trigger a sharp reversal bounce that overwhelms the short sellers, causing a panic short covering buying frenzy. This motivates bargain hunters to come off the fence, further adding to the buying pressure. Bullish engulfing candles are potential reversal signals on downtrends and continuation signals on uptrends when they form after a shallow reversion pullback. The volume should spike to at least double the average when bullish engulfing candles form to be most effective. The buy trigger forms when the next candlestick exceeds the high of the bullish engulfing candlestick. Bearish engulfing candlestick. Like a massive tidal wave that completely engulfs an island, the bearish engulfing candlestick completely swallows the range of the preceding green candlestick. This is a strong price reversal candlestick. The bearish engulfing candlestick body eclipses the body of the prior green candle. Even stronger bearish engulfing candlesticks will have bodies that consume the full preceding candlestick, including the upper and lower shadows. These candlesticks can be signs of enormous selling activity on a panic reversal from bullish to bearish sentiment. Bearish engulfing candlestick. Bearish engulfing candlestick. The preceding green candle keeps on assuming buyers' optimism, as it should be trading near the top of an uptrend. The bearish engulfing candle will actually open up higher, giving longs hope for another climb, as it initially indicates more bullish sentiment. However, the sellers come in very strong and extreme fashion, driving down the price through the opening level, which starts to stir some concerns with the longs. The selling intensifies as the price falls through the low of the prior close, which then starts to trigger some more panic selling, as the majority of buyers from the prior day are now underwater on their shares. The selling intensifies into the candle close, as almost every buyer from the prior close is now holding losses. The magnitude of the reversal is dramatic. The bearish engulfing candle is reversal candle when it forms on uptrends, as it triggers more sellers the next day and so forth as the trend starts to reverse into a breakdown. The short sell trigger forms when the next candlestick exceeds the low of the bullish engulfing candlestick. On existing downtrends, the bearish engulfing may form on a reversion bounce, thereby resuming the downtrends at an accelerated pace due to the new buyers that got trapped on the bounce. As with all candlestick patterns, it is important to observe the volume, especially on engulfing candles. The volume should be at least 2 or more times larger than the average daily trading volume to have the most impact. Algorithm programs are notorious for painting the tape at the end of the day with a mistake to close out with a fake engulfing candle to trap the bears. Video is too long, darling. I know it is enough for today. See you in next video with Harami candlestick charts. Until then, stay tuned, stay safe, bye.